Welcome to this explainer. Okay, so we're diving into one of the most wild, head-scratching macroeconomic paradoxes happening right now. It is May 2026, and Prime Minister Narendra Modi has just made a huge, highly unusual appeal to the citizens of India. He is literally asking people to pause their non-essential gold buying for an entire year. Yeah, you heard that right. An entire year. We're going to unpack the massive global forces that led to this exact historic moment, from the intense trading floors in London all the way down to your own personal portfolio.
So you've got to wonder, why? Why ask citizens to just hit pause on buying gold right now? I mean, think about it. We're talking about India here, a nation that relies on gold for weddings, for festivals, and honestly, as a fundamental bedrock for personal wealth preservation. Asking people to suddenly cold turkey one of the country's most culturally significant assets? It seems completely backward to normal consumer behavior, right? Like, it makes absolutely zero sense on the surface. Well, to understand the why, we really have to zoom out and look at the May 2026 macro crisis. Because, spoiler alert, this isn't about local jewelry shop dynamics. Not at all. It's a massive global financial squeeze. You see, escalating geopolitical tensions, specifically the widening Iran conflict, have completely wrecked regional supply chains and logistics. So transport and insurance costs, they've skyrocketed. And at the exact same time, crude oil prices have surged to a brutal $113 per barrel. Now, India imports about 89% of its oil. So when you combine punishingly high crude prices with massive gold imports, you're essentially just vacuuming US dollars straight out of the country. And that severe drain puts immense pressure on India's foreign exchange reserves, which just ends up hammering the value of the rupee.
To truly grasp how all this global pressure translates locally, here is our roadmap for this explainer. We'll be hitting 5 key sections. First, who sets global prices? Then, the paper gold illusion. Third, calculating India's price. Fourth, the macro domino effect. And finally, Section 5, wealth preservation strategies. Let's dive in.
Section 1. Who sets global prices? The heavyweights of gold. So a lot of folks assume gold prices are just kind of set by physical dealers or mining companies based on, how much metal is actually pulled out of the ground. It's a really common misconception, but the reality? It's dictated by massive financial exchanges. On one side, you have the London Bullion Market Association, or LBMA. They are the physical heavyweight. They handle global, physical, unallocated gold delivery. Just to put that into perspective, London handles enough physical gold every single day to fill an entire fleet of trucks. It's wild. But on the other side of the pond, you have COMEX in New York. COMEX is where the daily price discovery actually happens. And this is driven by massive volumes of financial futures contracts that are traded in literal milliseconds. And the way London sets its physical benchmark is fascinating. The LBMA uses a highly structured electronic auction administered by the ICE Benchmark Administration, or IBA. Here's how it goes down. The IBA publishes a starting price. Then, boom, 30-second rounds open up for auction participants to enter their buy and sell orders. Yes, just 30 seconds to figure out global buy and sell orders. It's incredibly fast for something so foundational. At the end of that quick 30 seconds, an algorithm steps in and checks if the difference between buying and selling, the imbalance, is within a strict 10,000-ounce threshold. If it's too far off, the price adjusts and they kick off a brand new round. Once it finally balances out, that final price is published in US dollars, and bam, that becomes the global physical benchmark.
Section 2, the paper gold illusion. COMEX futures.
So, okay, if the LBMA sets the physical benchmark, how does an electronic marketplace in New York dictate the minute-by-minute daily spot price? Well, it all comes down to futures contracts and leverage. A standard COMEX gold futures contract represents 100 troy ounces of gold. So if gold happens to be trading at $5,000 an ounce, that single contract controls $500,000 worth of gold. But here's the kicker. Traders don't pay that $500,000 up front. No way. They pay only a tiny fraction of the total value, which is called margin. This system basically allows institutional traders, big banks, and hedge funds to trade absolutely enormous volumes for price exposure without ever touching a single real ounce of physical gold. And this leads us to the stark, kind of crazy reality of the COMEX market. Typically, less than 5% of these massive futures contracts ever result in actual physical delivery. Think about that. 95% or more are simply settled financially before expiration. They just cash out. It's a massive disparity, making it a true paper gold market. The financial flows are completely overpowering the physical fundamentals in the near term. So yeah, it totally makes sense why physical demand at your local shops can be surging while the actual paper price of gold drops on the screen at the exact same time. Section 3. Calculating India's price from dollars to rupees.
All right, so we've got prices discovered in dollars in New York and benchmarked in London. But let's say you're a consumer walking into a jewelry shop in Mumbai. How does that abstract global price translate to the rupees quoted at the glass counter? Well, let's just run the numbers step by step. First, that international price gets converted using the US dollar to rupee exchange rate. So if the rupee is weak, the base price jumps immediately. Let's say that base price lands at, 6,832 per gram. But hold on, the government steps in next. They tack on a 15% basic import duty, then another 2.5% agriculture, infrastructure, and development cess, and a 3% GST. Suddenly, your base price of $6,832 balloons into a final wholesale price of $8,266 per gram. So basically, nearly 8.4% of what you're paying at the counter goes straight to the government in duties and taxes. And this is by design, folks. It's specifically structured to make importing gold feel very, very expensive.
Section 4. The macro domino effect. Deficits and reserves. Which brings us to the big question. Why does the government tax gold imports so heavily in the first place, and why are they currently begging citizens to stop buying? Well, history tells the whole story here. Before 2012, import duties were basically negligible. But around 2012 and 2013, Indian gold demand went absolutely through the roof, hitting 975 tons. The current account deficit, which is just the gap between what India earns and spends globally, hit a record 4.8% of GDP. And the rupee, it completely crashed. To fight back, governments kept hiking duties, pushing them all the way up to 15% by 2022. Then, hoping to ease the burden, the 2025 budget cut the duties sharply back down to 6%. But that totally backfired. The result was a massive surge in demand that helped create the record import bill we're seeing now in May 2026. You see, every single ounce of imported gold means dollars are leaving the country, which weakens the rupee, and in turn makes every single imported barrel of that expensive oil even more painful to buy. It's a brutal domino effect.
And honestly, there's a really profound irony in all of this. Retail consumers are being asked to pause their purchases to save dollars, right? But at the exact same time, central banks globally, and this absolutely includes the Reserve Bank of India, have been aggressively hoarding gold themselves. The RBI has accumulated 880 tons. Gold now makes up over 16% of India's total forex reserves. Central banks are scooping up gold as a risk-free hedge against global volatility and inflation. So picture this. You have massive institutions securing their own financial foundations with gold, while everyday citizens are being asked to hold off just to balance the national ledger. It's quite the paradox.
Section 5. Wealth preservation strategies. What investors can do. So with all this institutional hoarding, intense geopolitical conflict, and intense currency pressure, what on earth can a retail investor actually do to protect their personal portfolio? First off, you've got to separate the short-term COMEX paper noise from long-term trends. Day-to-day volatility is mostly just driven by hedge funds playing games. Definitely don't panic sell because of a screen blip. Instead, you want to monitor structural forces, like the global M3 money supply. Economic history shows us that gold and the M3 money supply have a really strong positive correlation. Basically, as money supply and inflation go up, gold generally follows right along. Now, if you want exposure to gold without importing physical metal and hurting the country's trade deficit, sovereign gold bonds are a fantastic option. They actually pay you interest income alongside the capital appreciation. And finally, view physical gold for what it truly is. It's long-term monetary insurance. It is absolutely not a quick, short-term speculative trade. Keep that perspective. We've seen exactly how physical demand clashes with paper markets, and how a nation's deep love for a shiny metal can literally sway the value of its entire currency. But all of this leaves us with one massive, lingering question about the true stability of our global markets. If we live in a system where COMEX daily volumes completely dwarf physical reality, and 95% of those trades settle entirely in cash, what happens to the global financial system if, one day, everyone finally asks for physical delivery? Think about that for a second. It'd be the ultimate game of musical chairs. Thank you so much for joining us for this explainer, and remember, always keep questioning the mechanics behind the money.